Hi there. Let's explain how HMRC receives information about interest and dividends and why understanding UK bank data sharing rules is important.
Imagine a typical UK business director. They use a merchant terminal for shop sales, a digital wallet for international contractors, and an exchange for crypto investments. Most people in this position assume their financial life is a private matter, something HMRC only investigates if they flag a specific concern. But the 2026 regulatory framework changes that relationship. The UK is moving away from a system based on targeted, on-request inquiries. Instead, the new infrastructure is built on mandatory, automated data sharing between financial institutions and the state. This transition is a response to the current UK tax gap, which sits at an estimated £46.8 billion. To address this, HMRC is integrating its Connect AI database with continuous data feeds from the private sector to monitor income in real time. This means that by the time you prepare a tax return, the government may already hold a digital ledger of your card sales, your e-wallet balances, and crypto transactions. Your financial data is being mapped before you even declare it. For small businesses and retail shops, the technical shift begins with Schedule 23 of the Finance Act 2026. This legislation specifically targets the reporting duties of the companies that process your payments. Under Schedule 23, merchant acquirers and payment facilitators must automatically transmit data on every card sale directly to HMRC. This includes both the total value of sales and the frequency of transactions. Because this data is pulled directly from the terminal, it creates a third-party record that you cannot alter. It makes it nearly impossible to underreport card revenues, as the government's records will show an immediate discrepancy with your filed tax return. For those using modern digital payment systems, the reporting net expands further through the updated Common Reporting Standard, or CRS 2.0. CRS 2.0 now treats e-money institutions and digital wallets as reporting financial institutions. This forces them to apply the same level of due diligence as high street banks, identifying and reporting account holders across international borders. Moving business cash flow into digital wallets or third-party payment platforms no longer provides a buffer. These capital flows are now as visible to the tax authorities as a traditional bank account. This reporting also extends to personal investments. On January 1, 2026, the UK launched the Crypto Asset Reporting Framework, an international standard developed by the OECD. Under these rules, crypto exchanges are legally required to report your activity to HMRC. As this diagram shows, your wallet transactions and balances are no longer anonymous. They are decoded and linked directly to your taxpayer profile. These rules also include look-through provisions for family offices and trusts. Even if digital assets are held within a complex corporate structure, the service provider must identify the controlling persons, the individuals actually behind the money. However, the most direct form of bank monitoring comes from the Department for Work and Pensions under the Public Authorities Act 2025. This DWP fact sheet explains the eligibility verification powers. As highlighted in the Policy Intent section, the department now requires banks to scan their own customer datasets to identify anyone who might not meet benefit criteria. If an account receives a benefit payment and matches a trigger, such as exceeding the £16,000 capital limit, the bank must share the details listed here. This includes your sort code, account number, and your full name and date of birth. Your personal bank account has effectively been turned into an automated reporting node for the state's welfare and tax systems. The risk today is that HMRC's AI system is already cross-referencing these automated data feeds against your historical filings. Discrepancies are flagged without the need for a manual inspector. A mismatch can lead to a prompted audit, where the burden of proof is on you. In severe cases of debt recovery, the government can now use direct deduction orders to seize funds from your account without a court order. To navigate this, you must reconcile your internal records with your bank and crypto data before you file. If the state already has the data, your self-assessment must match it perfectly to avoid an automated red flag. If you have undeclared income from previous years, the Digital Disclosure Service allows you to correct those records voluntarily. Taking this step before you receive a nudge letter from HMRC often results in significantly lower penalties. In 2026, the key to financial privacy is proactive accuracy. If you are concerned about your reporting obligations, contact us at ProTax Accountant for professional defense of your financial position.